Hello everyone. Today, let's take a closer look at one of the best-known investment tools, the stock. Let's start right at the very beginning and clarify what the stock is. A stock is a security with no maturity. It's so a little maybe dry and may not even tell you too much, so let's start at the beginning. How the stock developed and why a business needs it, and then let's also look at why you need it. When someone decides to become an entrepreneur, they buy the tangible assets needed for production and everything else to get started from their own pre-existing money. The money paid in by the founding members and the assets made available will be the equity of the enterprise. At first, of course, only the founders invest in this, and everyone acquires ownership of the business in proportion to the paid-up capital. As a business grows, it may need to raise more and more capital, which is no longer available to the owners, nor is it considered appropriate or just feasible to settle it on credit. This is when new investors are involved. The easiest way to do this is by issuing shares. To make appraisal and sales easier, the company is divided into equal pieces on paper. That is, they determine the number of shares. The value determined at this time will be the nominal value of the share. The share capital of a joint stock company is nothing more than the product of the nominal value and the number of shares. When a company is newly listed on the stock exchange, it is called an IPO, or initial public offering. This means the papers of companies that you have not been able to buy through the stock exchange so far. There are risks involved. After all, new areas are being opened up. This carries a risk even if they do the same thing as before. If you choose to do so, you can't rely on past exchange rates, so give priority to reviewing the company's past performance as well as past management results. If you buy a share in a particular company, it will also be true for you that you will be the owner of the company in proportion to your money paid, and thus you will be entitled to influence the life of the company or even receive dividends in proportion. Because the stock has no expiration date, there is no predetermined time for you to get your money back. You can do this by selling part or all of your shares at the current price because the share is tradable. The current exchange rate can, of course, even deviate significantly from the face value. You can easily pay up to 10,000 forints for a share with a nominal value of 100 forints. You may be wondering what you might need for the shares? Why would it be a good idea to pay up to 10,000 for something worth 100 forints, and for you, who are looking for a good place for your money, why would a share be a good idea? Let's start right at the very beginning with the yield opportunities. Since you will be the owner of a company, you can also get a share of the performance of the business. You can even get this from the dividends paid by the company, or by changing the value of the shares of that company. As the company develops, grows, its performance also improves and its market perception improves, so does its price. If they manage well and the market is open to the business, you can achieve one of the biggest gains with stocks. I would add that this does not go from 1 minute to the next. That is why the recommended duration of the shares can be up to a few years. Although there is also intraday trading in stocks, but I hope you suspect that not a single business can show significant growth in a single day. Thus, the exchange rate changes within a day for other reasons. However, the company's price and performance can not only improve, but can also fluctuate significantly in the short term. So invest in stocks only if you are able to handle these downturns in your head, and you can wait for the price to recover. Although you can achieve nice results with stocks within a year, but then you either have to understand it very much, or you seriously run the risk of getting out at a loss. The second advantage is the rights attached to the share. Obviously, investors don't accidentally pay a higher price the stock either. Because of the rights attached to them, they can still do well. Let's see what are the rights you can have when you buy a stock. First, you can attend the general meeting. Here you can influence the operation of a company based on your ownership. To do this, you need to invest a significant amount of money in a particular company, but it's not impossible. At the general meeting, your vote will be counted in proportion to your shares. If you are a major shareholder, your word alone will prevail against thousands of shareholders. The second right, the right to dividends. The company distributes a part of the generated profits to the owners, from which you can benefit in proportion to your shares. You are entitled to a dividend if the shares are already in your possession at a certain time. This will generally close within 1 week prior to the dividend payment. Dividend payment is a right, not an obligation of the company. So expect this only if they have something to pay dividends from. This is because the company is sure not to pay during a loss-making period. However, during a normal period of operation, they may choose to develop more from the profits generated, in the hope of a later, higher profit. The third right is the right to transfer. Since a share is a marketable security, you can choose to get rid of it at any time. You can do this at the current exchange rate, which is influenced by supply and demand. It can also mean for you to sell more expensive than you bought, so you win with it, but with a less thoughtful move, you can also incur a loss. Since selling is your sole decision, they are not covered by any warranty. The only guarantee you get with your shares is their records. That is, it does not disappear on its own. But this does not apply to sales made at the wrong time. This right is one of the most important rights for you anyway. If you only want to appear as an investor, with this right you have the opportunity to make a significant profit on the exchange rate movement. The fourth right is the right to control. If you do not violate a trade secret, you can get information about the operation of the company. Of course, this is just a limited right. With one share held, obviously no one will share strategic secrets with you. Now that we've looked at what a stock is and what you can do with it, let's look at the types of stocks as well. Stocks that give you the rights already listed but know nothing else are called ordinary shares. If you want to invest in stocks through a securities account, you will encounter the common stock most often. There are stocks that give you some extra rights in addition to the common stock. We now turn to these special types. As the share is transferable without restriction, the company may also decide to repurchase its own shares. These will be called their own shares. This obviously does not involve voting rights and is subject to strict rules. Obviously, a company needs to think carefully about when to decide to buy back their shares because it is also a message to its existing investors. The next type of stock is the preference share. With this type of stock, you can get something for the first time or more. Such a right could be, for example, a dividend preference, which entitles you to a more favorable dividend payment. This may be the case with voting precedents, where your vote is taken into account multiple times in the general meeting, or you may be able to veto it. Also, the liquidation priority may be related to this, in which case you will receive money after the creditors but before the other shareholders in the event of the company being wound up, so you will be more likely to get it if they don't run out of capital by then. The next special type is employee shares. Already in Hungary, it is becoming more and more common for a company to give employee shares to either all employees or only senior management. This serves to ensure that the employees of the company also receive a share of the company's current profits in proportion to their shares. That is, the better the team works, the more dividends they receive. Its transfer is obviously limited, and rules apply to its issuance in addition to its transfer. Special type of share is the interest-bearing share. The interest-bearing share entitles to a predetermined amount of interest in addition to the dividend. Interest is due to the owner even if the company does not pay dividends in that year. Last but not least, the convertible bond. This security is issued as a bond, as a debt security, but its owner may choose not to ask for interest and principal at maturity, but rather for the equity and subsequent dividends. You can't really encounter these special types of stocks on the stock exchanges, so let's get back to the common stock. You buy a stock at a given market price, but you can have a lot of effects on the stock price. The first of these is sales revenue. High sales revenue are not necessarily equal to high profits, but they are a good sign in any case. After the end of a successful year, the chances of increased dividend payments, expansion and maintaining stability are also higher. And investors are particularly fond of this. It also has an effect on the exchange rate if mergers or acquisitions have taken place. This is a double-edged sword. Obviously, a merger represents a greater market power, from which there may be shaky stages even in the early stages, but even a series of legal issues may arise. Stock repurchases also have an impact on the exchange rate. There is typically a good reason for a company to repurchase its own securities. Whatever it is, the amount of dividends paid per share will be significantly distorted due to the reduced number of units in circulation, and this may distract many people. Those who drive for higher dividend payments will specifically look for these securities, which can have a price-boosting effect. The number of shares may not only decrease but also increase significantly. Say a stock split. This is nothing more than doubling or tripling the number of existing shares or raising them by a different multiplier, while reducing their price proportionately. This will keep the same value in your property, only lower the sale price, thus increasing the marketability of the stock. This is usually done when the price of a stock is already too high for new investors to enter. This should not be confused with overvaluation, which is followed by a market correction, but helps the turnover of shares of an otherwise valuable, well-functioning company offered at persistently high prices. This has been the case with Tesla and Apple, among others. Significant dividend payments also affect the exchange rate, albeit only temporarily. Dividend payments reward investors on the one hand and also show stability. But there is so much less left for next year. Bonus payments also have an impact on prices. Just like any other business, a corporation does not pay a bonus just like that. Obviously, significant results need to be achieved for the bonus to be decided by the general meeting. However, the effect is the same as dividend payment. The introduction of a new product divides the audience, so of course it also has an impact on prices. A new product always comes at a significant cost, and it is far from certain that the market will be a buyer for it. Shareholders also know this and are either scared or see an opportunity in the product. Even so, there can be a big difference between a stock and a stock depending on what the company is focusing on. Now let's look at the main differences between companies that issue common stock. If you look at the prices of the two companies below, you can see that although they offered common stock for sale in the same way, they took a completely different path. What they have in common is that both can show significant fluctuations in the short run, but in the long run they have a much higher return outlook compared to normal commitments. There are companies that focus on growth, and there are companies that focus on dividend payments. Which company belongs to which type depends on their life cycle as well as on the industry in which they work. The difference between the two is that a growth-focused company may not pay dividends at all, or if it does pay, it may not pay much. You benefit from the fact that the business is showing significant growth. In this way, the price of your shares can also be sold at a profit. Such can be the technology companies that are going through significant growth. Companies that focus on dividend payments are stable companies with large markets. You can no longer expect further significant growth precisely because of their existing size, so the price of their shares is relatively stable. It shows growth, but not nearly as much as growth-focused companies. They can also pay relatively significant dividends, in part because of their advantage in terms of size and thus sales volume. A good example of this type could be the car industry or large companies dealing with personal hygiene. People typically use to wash and bath, so large crowds buy their products. However, in order to reach many people, they need an existing sales network and manufacturing technology. If you also choose the type, don't just base it on dividends for a single year. Review how much dividend you have paid in the past and draw conclusions from it. Let's see how you can invest in stocks. With stock returns, your earnings can be higher in the long run than, say, a bank deposit or government security, so you can use it perfectly well in your own portfolio. To do this, however, at the beginning, decide why you want to invest in stocks. You can also invest on a permanent basis if you want to keep the stock going. Then, because of their dividend payment, you can have a stable source of income regardless of their exchange rate. Then be sure to select the securities of companies with relatively high dividend payments and put enough money there too to make it worth maintaining the account. If you keep it cyclical, you will have to buy it at the beginning of the market cycle and sell it after the exchange rate rises. You don't necessarily have to expect intraday trading here, you may only decide to do so in 1 month or in 5 years. If you choose to do so, their ability to pay dividends is only secondary. You can choose undervalued stocks that have growth potential. They are with a high return but also a high level of risk, so buy it just to try. Invest money here that you can afford to risk and possibly lose everything. If you decide to invest in stocks, you can do so in different ways. I would emphasize that there is no right or wrong solution, just one that is optimal for you or less optimal for you. That's why you can use them mixed. You can also invest by buying individual stocks. Keep in mind that diversification will increase your security. If you are investing in individual stocks, you should also build a properly diversified portfolio. That is, do not invest your existing capital in only one direction, even if it promises a high return prospect. You can also invest in stocks through actively managed equity mutual funds. In this case, diversification can be considered solved by using a single investment fund, but you can even put your money to several investment funds. Through actively managed funds, you can achieve good results from growth, but do not expect to pay dividends. In addition to these, you can of course use a stock ETF. Following a predetermined logic, an index tracking fund invests your money in a passive way. Copies a stock index in a specific way. By using a stock ETF, you can copy the performance of the stock market without having to sit next to it on a daily basis. Here, too, this method follows the growth by compiling a well-diversified portfolio, so don't expect a dividend payment here either. As with any investment, there are risks associated with equities. As closing, let's see them now. The first risk is the lack of a guarantee attached to the shares. The face value and market value of a stock can be completely separated from each other, so it is your decision when to say yes or no to a buy or sell opportunity. The same is true of which company's papers you say yes to. We have already talked about the fact that there can be a serious difference between a stock and a stock, so there is no guarantee associated with the stock. Don't count on the help of anybody if you sold your shares at a loss. The second risk is the risk associated with ownership. Because a share is a security of ownership, it is worth as much as the business, or as much as the business is considered valuable. There is no problem with this as long as the business is operating normally. However, in the event of termination without a successor, you may find yourself in a situation where you get nothing. The owners are paid after everyone else, so you can only get what is left. In the case of bankruptcy, a very large liquidity problems, this is not too much. Pay special attention to this if you want to invest in companies that have just started the stock market. These have great growth potential, but full zeroing is also included in the deck. The next risk is exchange rate risk. As you give or buy the shares at the current daily price, you have no influence on this. Unless, of course, you have big capital or if you're an insider. There is no such thing as a good or bad exchange rate, just one that is more suitable for buying or more for selling. Your risk in this regard is that if you misjudge which stock to buy, you could even lose out on the transaction. Or maybe you're stuck inside for a long time because you don't want to sell below price. The last risk is the effect of the mass spirit. Even a group of the wisest people can turn into a flock of sheep and behave irrationally. Many people make the mistake of buying securities that are already heavily overvalued. They buy it just because everyone is still buying or just selling the stock they bought for holding, just because everyone is selling it. Before making a decision, either ask for expert help or be careful. Remember Warren Buffett's attitude. To make a profit in the stock market, be greedy when others are afraid, and be afraid when others are greedy.